You got to do your homework. You have to be a skeptic. You got to check stuff out. If it doesn't make sense, don't do it. But there are lots of things you cannot know. I think what you have to do on stuff you don't know is
it's the ability to just wait, not to be pushed into action prematurely.
just wait. There's real value in that.
Hi, folks. I'm really thrilled to be joined today by Fred Martin, a superb investor who's built a fabulous record over half a century. And Fred is joining us from his office in downtown Minneapolis. It's great to see you, Fred. Thank you so much for joining us.
Thank you, William. Good to be here.
When I interviewed you for my book back in 2017, we talked at some length about your father, who was a stockbroker for about 60 years. But you also mentioned that your mother was an incredible human being and was really the brains of the family. And then last night I was looking at my notes from our interviews back then, and I realized I totally and utterly failed to ask you about her. And she sounds extraordinary, and I know she had a big impact on who you would become. So I wanted to remedy that failure of mine and ask you, what made her so extraordinary, and how did she influence who you are today?
Well, I have 5 brothers, and they're all wonderful people, which is rare. They're all good husbands, good fathers, good people. And it was our mother. And so let me just give you the dichotomy that was a part of her life. So she grew up effectively as an only child, a pampered daughter of a rich banker in northern Michigan. And she graduated from college, I think, in 1939. You can imagine how many women graduate from college in 1939. She then had 3 years of postgraduate music education at the University of Chicago. So she was a concert-level pianist, concert-level soprano, a sculptress, a painter. She painted oil portrait of every one of her sons. I still have my painting of me. And not a very large woman. When she got married to my dad, she was going to have a child for the experience. And she had one, and something clicked. And so she had a boy. And then she started to have more kids. And then she had up to 3. I'm the 3rd oldest. Then she wanted a daughter. So then she went to number 4 was a boy. She was going to name her daughter Joy because her mother was named Joy. The 5th was named Jay, another boy. The 6th was named John, another boy. On the 7th try, she had a little girl. Unbeknownst to her at the time, she had I think it was ovarian cancer. And her little girl was born prematurely and died 36 hours after she was born. And 6 months after that, received a death sentence from 3 doctors, said, get your affairs in order, because that was pre-chemo, was radiation therapy only. And her response, which was absolutely true, she looked at the 3 of them. She says, I can't go now because I have 3 little boys at home. So she lived 25 more years before she got cancer a second time and died at age 67. So with that kind of history, you can imagine she's an idol to all of us in the family. The other amazing part to her was that if you had met her after cancer, she's one of these people that never said a negative word about somebody. She was either effusive in their praise or didn't say anything. But this amazing force, you would never know she had cancer. You would never know about her background. You never know about her accomplishments. She was one of these people that just, walked softly and carried a giant stick. And all of my brothers and I idolize her to this day. And my dad did too.
And how do you think growing up with such an extraordinary woman behind you, supporting you, shaped who you are and made possible the extraordinary success that you've had in your career?
Well, I mean, there's a yin and yang to it. There's a good and a bad to it. The good part was that she had an undeniable self-confidence, and which got passed on to me and some of my other brothers. So I start something with the ideas, how good am I going to be at this? I don't start with the idea that it's not going to work. So just a really high self-concept. The negative part was that I remember this vividly. In those days, you didn't have any special schooling. I was one of 6 boys, very active household. I was the second most creative member of the family. My brother younger than me is actually almost dysfunctionally creative, an amazingly creative guy. It wasn't until my mid-30s because I was working for then Mitchell Hutchins, and the head guy from New York came out to see me. I was maybe late 30s. And he said, you're one of the two original thinkers I have in the firm. I looked at him, I said, I don't know what you're talking about. Because so it took me years to marry up the self-image. And I think my mother could have helped narrow that up. A person that we all have different ways of receiving the world. And it was a struggle for me when I was younger to try to fit the world into what I thought it should be. Okay. And so, so there was the high self-concept. She could do anything. She knew it. So whenever I start something, I figure, well, let's see how good I'm going to be at it. So just an absolute sense of not so much arrogance as self-confidence.
Wow, that's a powerful gift. And I remember you once saying that being the middle of six boys forces you in some way to fight for what you believe in, to stand your ground. Can you talk a bit about that? I thought that was a really interesting insight.
Well, so my life until about 14, I mean, I have really high energy, but I'm average among my brothers of energy. I mean, they're, brother older than me, who's 79, still rides his bike 6,000 miles a year, his bicycle. Okay. The oldest one's a killer. He's got MS for 45 years and he's just a tiger. And so I've said my life until I was about 14 was trying to keep from getting killed by my two older brothers and exerting total physical dominance on the three younger ones. I mean, it's just like, it's chaos. And so I think the big thing is you get a strong sense of survival, because it wasn't a super healthy environment. We had really good parents, but it wasn't super healthy. But boy, you sure learned how to survive. Trust me.
That's interesting. So, well, survival will be a big theme of our conversation.
Yes, it was.
I mean, you've been an immensely successful investor for 50 years now. And so a big part of what I wanted to talk about is actually how you survive over all these years. So to wind forward a little bit, you ended up doing your undergraduate degree at Dartmouth and then graduated from the Tuck School of Business at Dartmouth. And then you left, I think, in 1969, and it was the middle of the Vietnam War. So you joined the Navy and ended up serving from 1969 to 73. I remember you saying to me once that you were an incredibly effective naval officer and you were cleared for command at sea at 22, I think, which I think means you were one of the youngest people in U.S. naval history to be actually cleared for command, to be given clearance to be in charge of these big ships. Can you talk about that experience of being in the Vietnam War for 4 years and what you learned by having so much responsibility thrust on you at such a young age?
It's a funny sort of starting point to that is that, so I was going to school in New England, right? And I was in NROTC. And so for some reason, and I cannot explain why, I had my heart set on being on a destroyer in Pearl Harbor, Hawaii. I mean, I bought a chart of the Hawaiian Islands. I circled Pearl Harbor in red, but it was really stupid because what I didn't understand was that was the front line for sending ships to Vietnam. So anyway, so my reward for that was I had 3 deployments. I was only in for 4 years, so I had 3 7-month deployments to Vietnam. So I was, home for 6, gone for 7, home for 6. I mean, you can run the math. So I got 3 tours in. So I had a tremendous amount of sea time. I recall coming out of, there was a big anti-war movement in the colleges. I remember starting, and for the first year in the service, I wasn't committed at all. I just remember that vividly. It was kind of half in. And then I somewhere along the line said, well, you got 3 more years, put the afterburners on. And then I got really serious about it. And then I started really becoming effective. So what I remember about was, first of all, the idea, or you go in as a kid, come out as a man. I came out as a very, very serious man. We fired big guns that fired bullets a long way. I had all kinds of intensive middle management. My last job, I reported directly to the captain. I had 65 people working for me. I've never worked that hard since, ever. It was grueling duty when you're, in a war zone. You're standing 8 hours watch a day plus your regular job. So the other memory is I got out, looked for a job, and I didn't get a single question about my Navy career, which is kind of interesting because that's all I knew, But there were a lot of clues in there about my self-concept, my effectiveness. Play the tape way forward. And I had this idea, unverified, but we learn stuff in our lifetime and you put it in the closet and 20 years later it comes out and you have this stuff that's there. It's knowledge is rarely wasted. It resides there. My management skills as a money manager are way above most money managers who tend to be loners and I got lucky because I had that middle management experience at an early age. And a lot of the functional parts of it, I use today in structuring the firm. So it was just like an amazing proving ground. The other part was I got these high ratings, and yes, I was clear command really early. I never wanted to stay in. I'd go see the captain. He'd say, "You're doing a great job for me. What are you going to do when you get out?" I was going to manage money. I was the unofficial financial officer to the investment officer of the ship. I remember looking at mutual funds and reviewing it for people. And, I was already thinking about investing.
And you were getting the Wall Street Journal delivered to you on the ship, right? In batches
In batches. Well, it was third rate postage. So you'd get, 13 in one dump, I mean, we'd get mail delivered by helicopter typically, they'd come and drop a big bag of stuff. Yeah, it was, it's hard to read when you get 13 in a row, because you're losing the pacing of it. But I was still very interested in investing even through the whole time in the Navy.
The other thing that seems extremely relevant about your career in the Navy is that you started, I think, in June 1969, right after this disaster that I wrote about in my book when I was writing about you in the chapter about Charlie Munger as well. The USS Evans had this catastrophe, which I think made you ultra sensitive to risk and the dangers of human error. Can you talk about what happened to the USS Evans, and which was another destroyer? So you were on a 437-foot destroyer, as I remember.
Right. About the same size, yeah.
Yeah, and as a young lieutenant, you would be in charge at night and have 240 people's lives basically in your hands when the captain was asleep, because you became the de facto captain. And you've basically just seen this disaster with the USS Evans. So if you could give us a little bit of color on what happened and the impact that it had on you, that would be great.
I can draw that into, which reminds me of sort of a book I read years ago by a wonderful author named Jim Ware about the psychology of money. It's worth reading. It's quite good. But I didn't realize at the time, but I was already very tuned to risk. Okay. There's pluses and minuses to that, by the way. Okay. So I grew up in a very active family of 6 boys, right? Well, if I saw something was risky and exceeded my risk tolerance, a daredevil can block that out and overpower it. I could never block it out enough. So we went to Chicago one time at an amusement park. The owner was a friend of my dad's, and he would put us on the rides, and the fastest roller coaster was there. And I'm the only one that didn't ride it. Okay. And of course you get called chicken, and my brothers are making fun of me. I eventually rode it later in the day, only after they tested it, and I was satisfied that it was going to be okay. I've done that snow skiing. I've done a lot of snow skiing. Typically I go to an area, I'll scout all the runs, ski them the next day. That's just, or if I'm in a pack of people and they're doing runs and I don't necessarily want to do the runs, I'll just split off and ski myself. What is the book, Psychology of Money? Jim Ware is a great thinker, by the way, talked about right-left brain balance. That is the ability to assess risk and opportunity simultaneously. And as you grow, and he claims Buffett has that, can look at both sides of it. And I think I probably have that. It's just it's a gift that you're born with. And I can never look at something and shut out the risk part of it totally. I can never do that. I can't. Okay. It's always there. And I can't shut it out. Well, that's good in a way. I could still go after the return, go after the opportunity, but I can never shut it out. So the Evans just crystallized in my mind, and so I'm starting to think, how do we avoid that? And one of the simple
just so that people know what happened, basically at 3 a.m. one night, the captain's asleep and a couple of these lieutenants who are young, very untrained guys are in charge, and they turn the wrong way and the ship is cut in two and 74 people died and they were court-martialed. And I remember you saying to me, Fred, you had kind of seared into your mind the image of the ship. What did it look like? It
looked like you took a welder and he cut off the front half of the ship. I mean, it literally looked like the ship just stopped, just almost where the bridge was. The front half was gone. It literally was right straight up and down. It's seared in my mind. So what you do is you start thinking, okay, I'll give you an example. When you're on a bridge, the radios are blaring. You got 6 or 7 people on there. You got the radio, the engine room calling you on something. You got all these distractions. You have to cut through all that. So I always had the habit of walking out on the bridge wing. If we're turning right, I'd walk out on the starboard wing and I'd take a peek to see what's out there. If we're going left, before we threw the helm over, I'd go out and take a peek. That was 15 seconds. But I want to make sure there was nothing out there.
So it's really like a simple rule, like very similar to saying when you're going to change lane in your car, that you're just going to look because you can't really trust your mirrors in case there's something in your blind spot.
Yeah, you got it.
And you said to me also once that basically the Navy was obsessed with the idea of process, of following process, honoring process. How did that twin obsession with safety and survival and honoring process affect the way that you've approached everything to do with risk in your life?
I have to confess to you that many decisions I made over my lifetimes were implicit decisions, not explicit. I didn't sit around and say, you got to think about processes, but I walked out of it seeing safety in the Navy was paramount. If you read the history of World War II, one of the reasons that we won is the Japanese thought their pilots were expendable and we would do everything we could to save a pilot. It turns out they're really expensive to train and you only have a certain pool. And so the Navy was obsessed with safety, which I thought was great. The process part had to do with this. You're on a bridge, so you've got multiple people. You've got a guy behind the wheel driving, and he takes orders from the conning officer. You always want to make sure everybody knows who the conning officer is, okay? If the captain's on the bridge, anytime he wants, he can say, this is the captain, I have the con. That means the only person that can tell that guy what to do is the captain. The XO could also do the same thing, the executive officer. So just think about that kind of clarity of thinking, that clarity of process. So, to carry it forward to managing money within my company, we have every stock, there's one person responsible for following the stock, and it's assigned. Everybody knows who it is. Every client we have, there's one portfolio manager that's responsible for shepherding that relationship. We don't move it around much. There's also one portfolio assistant that's responsible for, developing the relationship. So you see that kind of line clarity throughout. Okay. So I think that's sort of management 101. The idea of process, though, came more slowly. I wish I could give you a moment when I realized that it was the right thing to do. It might have been when I started DGI, because I was part of a star system. I think a group effort can be superior to one. If you have a group effort, you have to have a process. So that might have been the trigger on that. But I don't know whether the Navy itself was so, fired up on process. It was very fired up on clarity of communications, clarity of mission, and all those kind of things.
We'll come back to this issue of process and how you laid out your process when you started Disciplined Growth Investors, because I think it's a central aspect of your success. But to go back to you leaving the Navy, and as you said, you came out deadly serious. You came out in 1973, and you started your investment career as an analyst, having not had much luck with your interviews. You started as an analyst for the trust department of the Northwestern National Bank Trust, which is, I think, a Minneapolis bank that was later acquired by Wells Fargo. And you said to me before that it was one of the greatest gifts that you started your career in 1974. So you got to see the crazy euphoria of the early 70s, and then everything totally going to hell in 1974. Can you talk about that, about what a formative experience it was to go through the boom and bust of 73 and 74?
Let me preface that just a little bit by saying that because my dad was a stockbroker and I was a saver and I got fascinated with the markets. I think I bought my first stock when I was 10 or 11. Okay. So I had spent 15 years trying to figure this out without really, I was reading books, I was very interested in Tuck School, but Tuck School didn't really focus on investment management or analyzing companies. So, maybe the table was set. So I started Northwestern Bank. I'm a young guy and I open to learning, and it looked like price earnings ratios were pretty high. So I go to director of research, and I said, Stu, it looks to me like the market's pretty expensive. And he patted me on the shoulder and said, don't worry about it, young man, you'll learn soon enough. And then I had this weird mind for data points, and I watched the Xerox. Our analyst next to me was following Xerox, and it was a $140 stock, and it was going to make $2.35. I remember that. So that was about 60 times earnings. And they would lease copiers on a 3-year lease, double declining balance depreciation. So the sales were slowing, but earnings were still going up because depreciation was running off. And the stock, I think, went from 140 to something like 9. And then there was a mortgage insurance company called MGIC, and the star analyst was covering it, not me. And it was 100, going to make $2. So it's 50 times earnings. It dropped to 50, and he pulled the string, and all the PMs jumped in, and the bottom did 6. So I'm watching this, okay? And then from that point on, I started making a lot of money in stocks. I never stopped. And I think I saw the dichotomy between the company real value and the price of the stock. And it was compressed in a 2-year time frame from, the end of 73 to the bottom of the market in 74.
I remember you also telling me an extraordinary story where you had been following, I think it was Corning Glass, and you went to your boss, who I remember you saying was an incredibly smart guy and a really good investor. And you said, look, I don't really see any earnings here. I don't see any value. And he said, don't worry about it. It's a faith stock.
Well, he was the head of the trust department. He was a brilliant guy. I loved him. He was a fabulous guy. He said, don't worry about it. It's a faith stock. All of their earnings were from their unconsolidated subs, and it was an expensive multiple. It was like, so, I just watched, but I thought, wow, okay. It was a learning.
So Fred, when you saw a period like that, having lived through it viscerally and seen the nuttiness of it, how did that prepare you for the experience of, say, 99, 2000, or then 2007, or then the period with the FANGs before COVID? Because you wrote something in March 2020, for example, where you said, this is in one of your insights on your website. It says, 40 years after the Nifty 50 and 20 years after the rise and fall of Cisco, the stock market is once again in the grip of the great company lousy stock syndrome. The list of extremely overpriced stocks includes many small companies, but also includes the 5 largest companies in the US by market cap: Microsoft, Apple, Google, Amazon, and Facebook. And you were predicting at that time, if you compute the likely return for these 5 stocks that were about 20% of the S&P's entire value, you were expecting them to make about minus 3% a year at exactly the time when everyone was very bullish. So can you talk about how that early experience in a way prepared you for later periods of euphoria when people would become obsessed with great companies without realizing that a great company can be a lousy investment?
Really 3 times in my lifetime where you just hit, really extreme overvaluation. And so that's not a large statistical sample to learn from. So I would tell you that I think quantitatively, I learned a lot from it. I'll explain that in a minute. Emotionally, I don't know. It's miserable. Okay. Because the backside is always really miserable, like we're going through right now. What it prepared me for, it did something. And I mentioned we're working on a magnum opus on risk, because I think Graham always said, manage the risk and the return will take care of itself. Okay. And not all risks are the same. So, I mentioned that to you in the email I sent you. Overvaluation is a risk you can't diversify. If you have 25 stock portfolio that's overvalued, all the stocks, or 50 stocks, you're going to lose money. I don't care. Eventually, they're going to sell back to what they should sell for. So you can't diversify that away. It's also easy to quantify. It is actually easy to quantify. You can tell when something's like way overpriced. It's just really hard to deal with it for a variety of reasons. I didn't have this happen in 73 because I wasn't a portfolio manager, but I just observed, and I took advantage of the backside of it by finding stocks that were really cheap and making a lot of money with them. So that was okay. 99, 2000 was the worst period of my career for a variety of reasons. I just started DGI in 97. I was getting fired all over the place. There was a money manager in Akron, Ohio named Oschlager, Oak Associates, which was the Kathy Woods of this cycle. Okay. And I had a whole bunch of clients in Akron, and they were firing me and reinvesting in this guy. And of course, he took them down 80 or 90%. I had beautiful portfollios for him.
Yeah, and he had an enormous bet on Cisco, for example. So
he did.
He owned these incredible companies that were like the FANGs, or they were like the Nifty 50. They were great businesses. But I remember you saying to me, he just immolated his shareholders because they, it would have been fine maybe for them to have 10% of their portfolio in a racy thing, but they were giving him all their money.
He said, "I want all your money," which I thought that's just my opinion, but there's a hubris there that's pretty extreme. So that was kind of the first time I saw actually managing a business and managing portfolios, the blowback. I had clients sticking stocks in their portfolios. 2 or 3 clients didn't fire me, but they stayed mad at me for at least a decade or longer. One guy fired me. His wife stayed with me, and now he's a fan again 20 years later. Okay. And another guy was just mad at me. Part of it was they were embarrassed that they stuck stocks in there. They got killed, because stocks they stuck. I would let people put 1 or 2 in. That was about it. But it was miserable. I hated it.
And just to clarify, this is because most of your business is managing separate accounts, and typical separate account with you. At the starting point, I think the minimum is 15 million. I remember you once said that the average account is 30 million. So these are people who are supposedly pretty sophisticated on the whole, but they were still getting caught up in the euphoria. And we're looking at you making 12, 13, 14%. And we're like, what the hell are you doing?
I was actually, just to go way back, because we've had customers for a long time, a lot of the people that were arrested, we started with a funny story. I think they started with a couple, 200,000 or 300,000. They have 45 million now. Okay. They fired me in 99. So they started with 200,000. They probably had 10 million at the time or something like that. They fired me, and they're wonderful people. And I called them up. I said, "I'm tearing this letter up. I don't accept this. We have too good a working relationship. You can't fire me." And they said, "We'll talk about it." They talked about it overnight, and they said, "We changed our mind. We're staying with you." And they're still customers. So it wasn't that I had at that time. We raised our minimums after we had more money to run, but we used to have $1 million minimum. And so I had one of the things that's been meant the most to me is I've taken a lot of people that were hardworking people and made them a ton of money. And so that was the people that were turning, I went down to see some doctors in Northern Iowa, and I lost my temper, which I rarely do at a client. And they were criticizing me, telling me, like you're saying, at the time we were doing 17%, but everybody knew 25% a year was in the bag. And they started criticizing me, and they said, "You don't really know how to buy growth stocks." And I lost my temper, and I said, "Look, I have a thick skin. I can take a lot of heat, but you at least have to be accurate in how you're criticizing me, because you don't know what you're talking about." The lead doctor in the group, watch this, 3 years later, followed me out after I came down 3 years later, out to the car, and thanked me and said, "You saved us, and I can't thank you enough." And so they didn't fire us, but I was just taking a beating. So this time, and I'm going to put 07 aside for a second, because that was, I think the basis of 07 was the craziness in the financial system. I think the financial system, it wasn't so much overvaluation. It's just that the system was this close to collapsing. The one that sticks in my mind is 20 and 21. And I have to say, I think we did the best job I've ever done in the face of that. Okay. Because the reality is that, we go into this and we have some stocks that are too expensive, and they have huge unrealized gains, and we have a lot of taxable clients. So what do? And we sold outright a bunch of them and trimmed a lot of them and de-risked the valuation of the portfolio. So we enter this year with good investment value above our hurdle rate, if you will. Okay. And the down market just elevated our return, but we don't have an overpriced portfolio now, so we're not worried about that. There's still overpriced stocks around, and they'll eventually sell at whatever value they should sell at. So I think we did better this time, but it's still miserable. I'm watching the markets, and we're down. We're not down. We're down, I think, 18 or 19% from the peak of November of last year. It's not too bad. But I'm looking at the carnage everywhere. I don't know if you're seeing Tesla today. It's getting just destroyed in the market. So we don't have the waterfall declines that others are experiencing. We've had a couple of bad stocks, but you always do. But it's still miserable. I hate it.
Yeah, but you had warned specifically, you said Tesla was dangerously overvalued when you wrote about this
It still is.
in March 2020. So, I mean, the quote that I took from what you wrote at the time that I think is a very helpful thing for us to bear in mind when these infrequent periods happen. You said the disciplined investor must honor the financial laws of gravity and reduce or sell those companies with extreme overvaluations. The disciplined investor must ignore the discomfort and anxiety that comes from lagging relative performance, an inevitable outcome from avoiding or selling the stocks that are driving the market. And so I think that gets at a really essential truth, right? That this is painful. There's a lot of anxiety. There's a lot of discomfort. But having discipline, in a way, it gets back to your idea from your period in Vietnam, that it's the discipline and the process saves your life.
It absolutely does. But I think you're on a really key point, which is it's still very uncomfortable. You're still going to experience. So we get mixed complaints from clients. They would complain about their got a call not too long ago from a client. Oh, I paid huge gains and are down this year, right? So, and I got them calm down. So they blame us a little bit. And I have to sort of say to them, you got to put your big boy pants on because I don't make the tax laws. So it's uncomfortable. And you kind of have the idea that the backside of this isn't going to be pretty. If Tesla goes from, I think it hit 411 at the peak or 407, and it's 124 today or something like that. And our guess is, it's a guess, it may be worth 80, just a rough guess, 70, something like that. So it's getting close, but it's not, it's not where it was.
Don't worry about it. It's a fake stock.
Well, that's right. It's a face stock. And by the way, at $80 a share, it's still one of the great success stories in American history. I mean, it would still be worth $250 billion plus as a startup, which I think is remarkable. Okay. But it's not at its peak. It was the market value of Tesla was greater than the market value of all the other auto companies in the world combined. Okay. So it was, my point in saying it to you is, valuation is one of the easiest things to compute. You can be pretty accurate. It's also one of the hardest things to cope with because you have the chasing on the way up. We spent countless meetings explaining to clients why we weren't going up as fast as the Russell Mid Growth Index and showing the overvaluation of the index and all that stuff. And then you get to the backside, and now we have a different set of concerns. Is how high is the Fed going to raise rates? What's next year going to be like? So, and we get carried down, whether we like it or not, with the general, not as bad, but we get carried down. So I don't want you to, any way, shape, or form, I'm not looking for sympathy. This is part of the business. This is what it's about. And you have to suffer and you have to be uncomfortable, in my opinion, if you're going to be really good at it. You have to keep questioning yourself, thinking, is it different this time? Have the laws of financial gravity, inverted this time? Is it different? I just think that the idea that you can never, I call it keeping your sense of balance when you're investing. If you always say price is what you pay, value is what you get, you're on balance if your portfolio is well priced. Okay. You have to understand that you're almost always going to be at some state of discomfort. That's just life.
Yeah.
Okay.
Yeah.
If you want to be comfortable, you shouldn't be an investment manager.
You had another very formative thing happen to you, I guess, where, well, first of all, I think in 1973, the brokerage firm that your father worked for went bankrupt. Yeah. And I think you said to me that your mother basically lost her inheritance and he lost $500,000, which was a huge amount of money in those days. And so this was very personal, you seeing the price to pay for folly, exuberance, lack of carefulness. Because I remember you were incredibly candid when I interviewed you for my book in saying, look, my father was just a wonderful man, but a terrible investor. And I was wondering how watching this personal disaster unfold also informed your focus on survival, on avoiding catastrophe as an investor.
I got out of the Navy and my wife and I were on up on my dad's boat. He had a boat in Michigan, Lake Michigan, when the call came saying the firm had gone under. So it was like, I mean, we're right there, and he was a tough guy and he was an optimist. So he weathered it. But it was like, wow. And my mom, to her credit, forgave him for it. But it was a blow. My takeaway was, you got to do your homework. You have to be a skeptic. You got to check stuff out. If it doesn't make sense, don't do it. I'm fascinated right now with, and I don't know any of these people at Sequoia, but they invested in FTX. And FTX didn't have audited financial statements, at least for the balance sheet. It just fascinates me. How could you invest in something without audited financial statements? And I don't know if you remember Fannie Mae from, when it went under in 2008, but I think from 99 or 2000 to 2005, it didn't have an audited financial statement. And yet professional investors were buying the stock. And it just seems to me that you have to be a skeptic and you can't let your guard down ever. You can't buy something because a funny story. I had this client, he's still a client, and he got a retirement home in Florida. And the worst thing to do is go out and play golf with retired CEOs because they always have some hot story that they don't know anything about, but they think it's going to go up a lot. And he was always telling me about the smart money. And I finally had enough. And I said to him, if you look at our track record, we're the smart money. And he never brought it up again. But how much taking tips from people, where you hear all the smart guys are buying this, or, all these people are in it. Or I think part of what happened with like FTX, he got in the deal flow, and so if you're Sequoia, you got to buy the deal because you got other deals coming. I don't think it's irrational to think that you're going to sweat every investment in your portfolio. You're never going to let your guard down on any investment. I don't care how big it is. You're going to, because you can't, you just have to be pretty anal about it. It's a point of view, but I think you got to check everything out. You got to keep asking questions.
Well, you once said to me, Fred, the golden rule of risk management is to know what you own. And like all great truths, it sounds like a total platitude. But if you think about how much trouble people would have avoided by really looking under the hood of FTX, if that was possible, or Fannie Mae, or many of these companies, or just saying, I can't look under the hood. I don't know. It's not possible. But that simple rule, and this has been a big revelation for me, is just increasingly to think, well, I know a fair amount about the psychology of great investors and their lives and how they think, but I really am not very well equipped to understand the finances of companies. I'm not very interested in it. And even though I worked at Forbes and wrote for Fortune and stuff like that, I just don't really want to sit around reading 10Ks and stuff like that. It just doesn't interest me. And just that recognition that I'm not equipped to analyze and value businesses has been kind of painful and very liberating at the same time.
One of the things I really, really enjoyed about your book was your own personal sort of reaction to the people you're interviewing. I thought it was fantastic.
Oh, thanks.
And I mean that. I think it's really a great book. I mentioned to you that I had such a mixed feeling. You really got us, and I like to be a little bit under the radar, which was a little bit disconcerting. But that short section on me, you got it so accurately that I wanted to find out what you wrote about everybody else. I read the book. I'll read it again one of these probably the next year or so. I'll read it again because I think it's quite valuable.
Well, what I was going to say is one of the great lessons for me of writing about people like you or Charlie Munger, who I wrote about in the same chapter, was to realize I'm not you. I'm not well equipped for this game. And so I think part of your advantage, right, is that very early in your career also, it wasn't just your wiring. You studied for your CFA. I think you got it in the designation in 1978. So you were studying Ben Graham's book, Security Analysis. And so you were kind of learning the rules of the game and internalizing them very early. So I wanted to get a sense of how you came out of studying Ben Graham after the irrational exuberance of 73 and then the crash of 74. Then you're studying Graham around 77, 78. You must have come out with this sense of clarity about how the game works, about what the rules of the game are, what the laws of gravity, financial gravity are. Can you give us a sense of what you came to believe about the fundamental rules of investing, having studied Graham in this deep way.
Yeah, but hold that. I just want to compliment you on.
I like any sentence that begins with those words.
Well, no, but what I didn't tell you. So my time at Tuck School was pretty useless. I only remember two things sort of about it. One is that one time they had a money manager, come from Boston, from some Boston firm, to give a night talk, and I was just enthralled. It was one of the few things I remembered about Tuck School. The other thing was that we had to take a statistics course, and I had a freakishly high aptitude for statistics. And I remember going to the final exam, and my score going into the final was 20% higher than the next guy in the class. Okay. So having a facility for numbers, okay, is a huge gift, right? Because, and having high math aptitude. And this is really strange, but I remember when I grew up in a small town in Indiana, I'd be walking home and cars would go by and I'd watch the license plates and I would jigger the numbers around to add them up and subtract, add them together. And so I could get to zero. I mean, who does that? Okay. So you're perceptive in saying, and the truth is when you start off as a money manager, you don't really know if you're going to be good at it, right? You're just a young guy and you're trying hard. And for you to realize that mostly you don't have the interest in it. So I'll give you an example. I have spent until the last month no time on cryptos. I went to my young guys and said, what is it? It's a currency. Well, that's not an investment. Let's not worry about it. I'm fascinated now. I'm reading everything I can about FTX because I'm fascinated with the autopsy. I'm fascinated with learning from this as to what happened. What can we learn from it? Okay. And so this is just an area of interest for me. And for you, it wouldn't be an area of interest. What is an area of interest for you is being able to very perceptively pull out from money managers, the good ones, what it is that they do. And I mean, it's a gift. And so I think you're following your gift, but if you try to come into money management and you're not understanding that there's a big difference between an audited financial statement and an unaudited statement. And, that's like, for me, it's like a neon sign,
Yeah, whereas I think I would hear the audited statement and my eyes would start to glaze over.
Yeah,
whereas I look at some obscure book on, Tibetan Buddhism or something, and I'm like, oh, cool. There could be something that relates to this, that relates to this. And
that's your strength.
Yeah, I think you have to somehow be doing what it is that you're naturally obsessed with and good at.
Yeah.
But you also, you got lucky in a sense that you studied in the right church, right? So you studied Graham and I did. That there were these fundamental laws of investing. And I think we should spell out what some of those laws of investing are for our listeners, because in a way, they're the backbone of what you've done for 50 years. And the first one I would say is, you once said the discount to intrinsic value is the best predictor of future returns. So can you talk a little bit about just the focus on intrinsic value as opposed to market price, which is it's such a fundamental idea.
It is. But let me preface that by sort of responding to what reading Ben Graham did for me was say, there is a path you can systematically invest in the markets without knowing all the pieces of it. And Buffett comes along and takes his stuff. He was the one that took Ben's stuff and put it into practice and articulated it beyond that in a way that makes perfect sense to people who are serious about long-term success. So what they did for me is say, you can do this. There is a path. Okay.
Yeah. It's not just random. There are these rules of the game.
It's not random. They're rules of the game. Okay. And so the number one rule is price is what you pay and value is what you get. Well, okay, so let's unpack that. Okay. The hard part of that is what's a company worth? That sounds like, Fred, that's like investing 101. But let's unpack that a little bit more. If you say to yourself, we are going to be focused and we're going to do one more twist. Because we're buying growth companies, we're going to push out a future value. We're going to make a forecast, and we're going to make our decision, look at the stock price today, but we're going to see what it's worth out 7 years. We're going to go past an economic cycle. Okay, so we're going to do a little bit of forecasting. We can talk about that. But we're going to build this intrinsic value thing in our heads. We think in 7 years, forget the stock, the company is worth X. Okay. That's what we're going to do. One of the things that I've learned that's opened us up to do, because if you always want to keep back checking yourself, right? Keep challenging yourself. And so, we're a value investor. Ultimately, we're buying growth companies, but we pay a lot of attention to value. A lot of the value investors have imploded the last 15 years. And here's our guess. They thought the best measure of a cheap stock is the price earnings ratio. One of my guys, Rob, is a brilliant guy. We started thinking about, is the P ratio the only way to think about the value of a franchise? How about free cash flow? How about the fact that America is a much more asset-light economy now, and so they don't have to put as much back in a building, so free cash flow is higher, yada, margins are better, yada, yada, yada. How about companies like ARM Holdings that sell only the royalties to the designs for the smartphones, right? I mean, so we expanded our notion of value out. We had two companies that shifted from shrink-wrap software subscription model, Intuit and Autodesk. We held them, the earnings collapsed because you push the revenues out, the expenses are still there. So for a year or two, the earnings go way down. But the lifetime value of subscription is higher than shrink-wrap software. Okay. So I thought we did a great job of saying, we're never going to violate the principle, but we will be open to thinking about it and broadening our understanding as opposed to debating the principle. And I can't tell you, because all this stuff takes emotional and mental bandwidth, analytical bandwidth. If we're debating, price is what you pay and value is what you get, but this time it's different or whatever. Okay. The idea of the price of it is relatively easy. Look at the market value of the company, figure out what the total value of the company is in 7 years. And if it has a high enough expected return, it's again to buy. I mean, that's the easy part. The hard part is this whole notion of value. And I do think that I believe that you can get better at how you figure out value. We use a probability weighted expected return now, that we probabilistically figure out what they're worth. We're not trying to be an accurate forecast. We want an achievable forecast. There's a big difference between those two. And so there's a lot of things you can do. You can get better at this. And I think we are getting more and more skilled at making forecasts, which means that we're getting better at the expected return. Okay.
And to get back again, Fred, to this idea of adherence to process, one of the reasons why you've survived and outperformed, I think, over so many years is that you very consciously have this consistent investment approach that's built around 3 steps. And so when you founded your firm, Disciplined Growth Investors, back in, I think, 97, you wrote this down. I wondered if you could just take us through those 3 steps, because in a way, it's a very practical application of these kind of financial laws of gravity. It'll help us explain how you take advantage of those laws of financial gravity. So the first stage is what?
So the first stage is understanding what you own. Again, let's parse this out. Let's not have our analysts look at a company and already start thinking about building a forecast, because you're going to skip the other steps. So what's executive compensation like? What is, how do they make money? What kind of business do they have? Okay. What are their margins? How good are they? All those kind of things. And if you can't figure out how they make money, leave it for somebody else. I mean, there's a basic humility in saying, this saved us with Enron. We looked when Enron hit $10 a share on its way to zero, because it looked like an interesting business. We looked at it. The financial statement was so complicated. We just threw our hands up and said, we can't understand this one. We'll let somebody else have it. So the idea is, this isn't a forecasting effort. That comes next. This is an understanding effort. Can we figure out how they do business?
Okay.
And, are they good at what they do? Yada, yada.
So step 1, you're analyzing the company, researching the business very thoroughly, seeing how it operates, trying to figure out what the competitive advantage is. So you're starting with the facts. Step 2 is much more about building a really detailed financial model. Can you talk to us about that, what you're doing there?
Yeah, sure. And that's where we spend the group time on the model. Okay. and we've gotten, it's not proprietary, but it's close because we have a model that it's interactive. So we'll say, well, what if you got them growing at 9%? What if they grow at 11? Or what if their margins do this or that? We can play with all kinds of different assumptions there, right? And it's a very granular model. We build it up typically product line by product line. And we do a lot of visualization, like, how big is their addressable market? What's the competitive landscape? All those kind of things. So we're trying to look at this thing. And I would say in our process, we spend in the group meetings, we spend 90% of the time with that. We're trying to get as clear a picture as we can, as achievable picture of what it's going to look like in 7 years. Okay. And people have said, you guys look like a private equity firm. And I said, yeah, but we charge a lot lower fees. But that's all. By the way, we lose a lot of companies to private equity firms, and because they're looking at probably the same data we're looking at. And so that's the continue to try to refine that.
So stage 2 is constructing this detailed financial model where basically you're estimating what the earnings are likely to be in 7 years' time.
Yeah.
And then stage 3, this is where you're calculating your expected return.
Yeah,
right?
that's all.
Can you explain what you're doing and why you have these specific hurdles for small caps and mid caps, which are the two areas you focus on?
Yeah, we use so the last step is you simply look at the price of the market value of the company, and you figure out the future market value. You say, okay, working assumption, not unfair, is that over time the stock market's a weighing machine. Short term, it's a voting machine. So intrinsic value and stock price tend to true up over time. Okay, maybe not perfectly, but tend to true up that way. So the last step is to say, okay, the stock's here. We think, it's going to be worth something in the future. In the mids, and this is a key point that I'd like to make, we need a 12% higher annual compound return to buy a mid-cap company, 12% or higher. We need 15 or higher for smalls because it's riskier. Okay, that's why we put that in there. Now, why 12? There's nothing magic about that, except here's a working assumption. If we do 12% for you, you're probably going to keep us. Okay. If we do 6, you're probably going to fire us. We've priced our fees off that, by the way. If we do 15 in smalls, we're going to be a superstar. And in fact, over our history through, I think last month, we were, about 12 on our mids, almost dead, in 27 years, which is kind of amazing when you think about publishing that. It leaves us vulnerable. If the market's going to do 15 for 3 to 5 years, we're probably going to, get some heat from customers, step it up if we're doing 12. But what it does do, it's very simple. It's very straightforward. We've used the same hurdle rate since we started. No debate about it. So it's just a judgment call.
But this is important for a couple of reasons. One of which is it's this repeatable process, right? This consistent adherence to a process where you're saying, I'm not going to take valuation risk by overpaying for these stocks because then the expected return just doesn't justify the amount of risk that we're taking.
That's correct. Yeah. I mean, just think about the clarity you have. It's all against the hurdle rate, right? So we had stocks in 21 that had a negative expected return over the next 7 years. Well, those were, largely sold. So it gives you clarity. It also, in 08, where we showed a 25% plus expected return, we said, hey, you got to own them. So you build time series in there. So just to play it where it is today, we entered this sell-off at the end of last year. We had about a 14% expected return on our mids. With the down market, we're pushing 20, which is not as high as 08, but really high. We're all in because it's just too good a return. So it gives you that clarity. We're not debating like, oh, interest rates are up. Should we raise the hurdle rate to 15 because rates are up? I don't think so. Every time you introduce some other variable into a model, you have a whole debate and everybody gets confused. We think 12 is a good number.
There's something else that you mentioned, Fred, in passing there about the truing up process. And I think it's really important to sort of dwell on this for a moment because it's one of those really profoundly fundamental insights into investing. And you once said, I'll quote you. You said there are two sources of return for a stock. One is the growth in intrinsic value. The other is the truing up between where the stock is and where the company value is. And the timing on the truing up, the second part of the return, is completely random. That has some really profound implications, right? So this gets back to the idea of the market being a weighing machine in the long run. But can you also talk about the importance of patience, given the fact that you have no idea when that truing up is going to happen?
I'm working on a piece right now where I'm on navigating bear markets because, I've been through 9 of these, 2 giant ones and a bunch of doozies like this one. And you always get late in it whenever we are. I don't know where we are in this one. You wonder, is it ever going to, when does value kick in? And Ben Graham says that's one of the mysteries. In 1955, I think he was testifying to Congress and they said, what turns bear markets? And he said, that's one of the mysteries of our business. Eventually value takes over and it turns. But there's never a green light that comes on and says, okay, kiddies, it's time to come in the pool. There's no free lunch on this stuff. And I think one of the hardest parts about what we do is the fact that we do not have control over when the intrinsic value and the stock price begin to true up, because you can go for several years and have that happen. And it is just, so what you try to do is, one of the great things I learned from Buffett is he's a teacher. He's always teaching. He's just incredible at how he can take complex things and make them simple, right? So we spend a lot of time teaching our customers, educating, exactly what you're saying. Look, we don't know when it trues up. It's going to take patience. It's a terrific company. If you do it enough times, they start to have confidence because they've seen this happen over and over and over again, and so we have a high credibility quotient with our clients. But, at least 1 or 2 or 3 always get restive. When is it going to happen? When is it going to happen? And I think it's one of the reasons why I'm willing to tell people exactly how to do it, knowing how hard it is, because you don't have any control over it. And this idea of, we've been toying around with uncertainty versus risk. And, there are things and what you can control and can't control. You can control the quality of your work. You can control what you want to pay for something, but you can't control when intrinsic value and stock price begin to true up in either direction. And that's a hard one.
But knowing these fundamental laws of financial gravity is a pretty good start. But as you say, the execution is excruciatingly difficult because all of the fear, all of the uncertainty, all of the institutional pressures from clients who can leave you and fire you, your own emotions. There are so many things that come to play here. But the fact that these laws of gravity is a really helpful start. And your average holding period for stocks is the best part of 11 years. So,
right.
So you're allowing time for this force of gravity to play out.
Every way I can, I try to teach clients, like, I'm getting calls, what do you think about the market next year? I say, I have no idea. I can't imply that I know what's going to happen next year. I might have an opinion, but I got about a 50-50 chance of being right. But I just try to, everything I do and everybody here keeps trying to say, we don't know what's going to happen over the next 6 to 12 months. We don't know. We know we have great stuff.
So is the key, Fred, to focus on what is knowable, which is the intrinsic value and what you think it's going to be in 7 years, which is not super knowable, but somewhat.
But it's absolutely knowable to avoid valuation risk. It is absolutely knowable. That, I would say to you that just, having said P ratios are not a super leading edge, but they're not unimportant, okay? Or price of sales, you can do back of the envelope. We're not experts in Tesla, but we did back of the envelope calculations. It's an auto company, gave them margins and all that stuff. Looked at the auto business, and you can do rough analysis and you can kind of figure out what it's worth. So you can know how well priced your portfolio is. You can know that. But there are lots of things you cannot know. I think what you have to do on stuff you don't know is live your life carefully enough so if you're wrong on that, you can survive.
That's a very
you,
profoundly important point.
it is. It
And
is.
you wrote to me the other day, I think we may have uncovered the greatest risk manager of all time, the climber
Yeah.
in the documentary Free Solo. And I wondered if you could talk a bit about this guy, Alex Honnold, who is a master of, I don't know how many of our listeners have watched the movie. There's a great documentary called Free Solo that's about this guy, Alex Honnold, who decides to climb, I think it's El Capitan, so this 3,000 or so foot sheer granite cliff. I mean, it gave me a heart attack just watching the thing. Can you talk about what you can learn from someone like Honnold about dealing with uncertainty, dealing with risk, mitigating risk in a really intelligent, thoughtful way, since we don't know what can happen or what will happen? We can guess what can happen, but we don't know what will happen.
Did you watch the documentary?
Yeah, and then yesterday I watched something about the filming of the documentary, which is terrifying in its own right. And one of the things that the cameraman said while making the film is that they had to record part of it with remote cameras because he said he didn't want them to see him die because they were friends of his. Okay. So during the most dangerous bit, they actually had to set up remote cameras.
Oh my God. Okay. So funny. So Rob is he's spearheading the piece on risk. This has been in our heads for years, right? We, this idea of trying to get better and, I really believe if you really want to learn something, well, teach it, and so the teacher always learns the most. And so he writes this thing on.
This is Rob Nikoski, who's your
So he writes this. Chief investment officer. He starts with Free Solo, and I freak out about it because I'm going, wait, we're not talking about falling off cliffs here. But as I started thinking about it more and more, and I about a month ago, I called Rob up and I said, I think I'm not looking at this right. This guy was one of the greatest risk managers of all time. And we need to look at it. I need to look at it differently and say, my goodness, he took this thing with a binary outcome and he made it. And there were 1,000 little threads to make that. So this is really deep stuff, but what this has to do with is risk mitigation. Okay. And what's in your control and what's not in your control. Okay. And so what he did is he climbed it many times. He was a very experienced climber. He was physically fit. And he practiced those moves with a rope over and over again, right? Now, he also, as part of the thing, one of the things that struck me as so profound in the whole thing is, I don't know if you remember in the movie, he was going to climb and he got partway up and said, this isn't right. And he went back down again. I don't know if you remember that. And I remember thinking,
I'd forgotten that. Yeah.
I thought, oh my goodness gracious. This guy, he's got the risk meter going in his head. He's not ready. It's not right. And he knows that this isn't the right day. And just think of the humiliation he must have felt and the sense of deflation because you don't just show up when he's having to climb it. You build to it. You're all fired up. You start up there and he gets partway up and goes, oh, not right. Climbs back down.
It's interesting also, Fred, I saw an extraordinary video of him last night where he was teaching a famous Scandinavian climber to free climb. And he said to the guy, when you get stuck, just be patient and take the time to figure it out. He said, you get in trouble when you're in a hurry. So when you can't figure out how to get out of it, just pause, be patient, and give yourself time to figure it out. And and he's talked about not letting your emotions spiral out of control when you were stuck. And so there's a kind of an incredible ability to get his ego under control.
It's astounding. It's just by the way, you should try to get him on your podcast.
That would be great. Yeah, he's a fascinating guy.
Well, because if you look, he had a binary outcome, but he also had the ability to practice over and over again. He climbed it, right? And he was he stacked a lot of things in his favor. It doesn't guarantee that he didn't fall, but boy, he sure did a lot of risk mitigation. He also, there is another idea that we're debating, and that is, Buffett said this many times. So it is possible to get the market return. You can buy an index, an S&P 500 index fund. Anybody can do it. When you try to get an excess return, the field gets really narrow and it becomes all about process and implementation and the ability to take intelligent risk if you're going to do superior results. because if you try to do superior, you may end up with inferior results. Okay. So this kid, had the potential to rise to the top of this, but he had to really do risk mitigation to make it. And it's true investing. To as you move up the food chain, as your performance gets better, you better really manage the risk because it'll kill you. I'm still turning my head over on his comment about be patient. It's true investing. We have I went to flight school years ago, and one of the buzzwords was one of the things you train for in flight school is you train crews, which is kind of interesting, but you train when stuff goes wrong, a red light on the cockpit starts blinking. Well, first thing you do is look at it, right? And it's not fun, right? Something's going wrong, right? But there's a saying, wind the clock. Just let it blink, just wind the clock. Okay. Because you don't want to overreact. Rarely is it life-threatening, the first part. You can make it life-threatening. One of the extreme examples, and it's happened in the past, is you're lifting off in a 2-engine plane, right? And just as the plane hits a certain speed, you rotate, you lift off, your engine quits. So fly the plane, wind the clock, fly it to a safe altitude and deal with it. Even if you have an engine fire, deal with it when you get to altitude. Okay? Why would you do that? Because you don't want the guy in the right seat to reach over and pull the wrong lever and cut the power off to the good engine. That's happened. So excitement in the cockpit, I call it fast hands. I don't like to fly with guys with fast hands because they'll push the wrong button. That's a bad idea, flying. So I love his advice. When you get in a jam, slow down, think about it. You're safe where you are right now. And it's true investing. Think about it. Think about it. You don't ever have to be in a rush to lose money. You really don't. And, Buffett always talks about waiting for the fat pitch to come over the plate. Just wait. There'll be other ones coming. Just slow down. It's a really good way to think about it. Just slow down.
Honnold also used a very interesting phrase where he said he did enough preparation so he could step outside his fear. So that's
wow.
This was in another video of his. And he had trained for, I think, 2 years weighing whether to attempt this climb that he ends up doing in something like 3 hours, 57 minutes. I mean, it's very profound, I think. Josh Waitzkin often talks about thematic interconnectedness, right? Where you see something in one field that applies in another field. And there's something about Honnold's ability to control his emotion that's very applicable.
I don't have, you talked about that capacity for you in terms of looking at balance sheets as a right-left brain balance. I don't have the capacity to put that risk out of my mind enough. It would impede my ability to execute because I would be thinking about falling. I wouldn't even try to do that because that risk profile is beyond. He had to be able to literally dissect every risk on the way up, different handholds, everything else, all the experience he's had, like you're saying, massive preparation. It's one of the greatest athletic feats of all time, but it's also maybe the greatest risk management exercise of all time. I started by objecting to have it in there because I thought we don't want to have people thinking about falling off the cliff. But then I made a 180 and we're using the theme from him. And I'm going to take your quote and give it to Rob because we're going to try to get that in there because I think that that is, there's an idea on decisions. And I've said this to many people. So let's say there's 3 kinds of decisions: A decisions, B decisions, and C decisions. A are great decisions, make them. C are bad decisions, avoid them. Where people spend way too much time is on B decisions. They try to make them before they either turn into an A or a C. So if it's a B decision, don't do anything with it. It's just a B decision. Don't waste time on it. See what happens. It'll either migrate to C or migrate to A. That's just, so that idea of patience, I think is, certainly investing, patience, but patience on decisions. Sure. I think it's a great idea.
Yeah, I talk about this in writing about Ed Thorpe in the introduction of to my book, where he talks about part of rationality being suspending judgment. And then my friend Gillian Zoe Siegel, who wrote about Buffett in her book, Getting There, I remember her quoting Warren saying, you can always tell people to go to hell tomorrow. I think he used slightly cruder words than that, but
Yeah.
again, it's the ability to just wait, not to
Yeah.
not to be pushed into action prematurely.
Just wait. There's real
Yeah.
value in that. There's,
Can we talk a bit about flying? Because you obviously are a very experienced pilot, and in the acknowledgments of your book, you talk about how Jim Dobesh, who's been the chief pilot for your firm since I think 2003, and who's obviously a very interesting guy, I think former paratrooper and ranger and stuff. He's got game.
he does.
You said, in addition to his superb flying skills, he showed me how to apply the margin of safety to flying.
Yeah.
And I wondered if we could talk a little bit about how this fundamental idea of the margin of safety, which you obviously applies in climbing solo on a mountain without ropes or anything, also applies in investing, also applies in flying. How has it helped you in flying, this idea of the margin of safety?
Oh my goodness. Let me just, again, when you ask these questions, they're great questions. I always try to flash back just for a second. So let me go back to Ben Graham for a second. So, Graham had a searing experience in the early 30s because he lost a lot of money. And that's how he really recovered and began to teach and became a much better investor. And he always said margin of safety was the discount to intrinsic value. And I thought that's true, but I thought margin of safety was broader than that. And my definition of margin of safety is it's things you do to keep adverse events from becoming catastrophic. Okay. So adverse stuff's going to happen. The question is it catastrophic or not? And so when you take that approach, you can start to think about, in flying, there's adverse stuff that happens. Equipment breaks, you have weather, you have unexpected traffic, you have this, you have that. So how do you handle these adverse events without having it becoming catastrophic? Well, then it gets interesting. So there's a million ways to build margin of safety. The first thing is you have to acknowledge how important it is. Okay. And, I asserted in my book that the pilot community has a much better feel for margin of safety than the investment community because it's much more deadly if you keep violating it. Okay. But the first step is to recognize it's really important. Second is to implement processes and steps that enable you to maintain a sufficient margin of safety. And Jim and I have flown together for 25 years, and we still every flight try to build a margin of safety in. And it can be, we went to Denver and back a week ago, and terrible weather forecast both directions, and we have our alternate plans, and so that's how you start to build it. We have plenty of gas. We build a margin of safety, and it's a whole bunch of different steps. But you have to constantly think about margin of safety. You got to always be building that. And it's true in investing.
You once told me that you had an agreement with Jim that basically both of you could veto
absolutely
the trip
with no argument, no talking back. I'm not comfortable with this. We're going to turn around.
Why is that so important?
Because it keeps you from talking each other into killing yourselves. Like, I'll do it if you'll do it. Remember, he's an ex-airborne ranger. I'm not exactly a wallflower. We can do this. Okay. So that's what it prevents. I'll do it if you'll do it. That sort of thing. Your gut's telling you it doesn't feel right. I'll do it if you'll do it. And then he goes, well, I'll do it if you'll do it. So now you both have dropped so both of us are, we had a funny thing happen. So both of us consider that we are solely responsible for the safety of the flight. We've gone to flight school many times over the years. We had one session down at Wichita, and it's a 3 days in a simulator, 3 days. First day we were awful, and we have a really good reputation. And the sim instructor's kind of looking out of the corner of his eyes like, I thought you guys were pretty good. And we knew we stunk. So we discussed it ourselves, at dinner that night. And I think Jim or I said, neither of us acted like a captain. There was no captain in the plane. For some reason, both of us decided we weren't going to be a captain today. He said, you're right. So we corrected that, aced the course after that. But just this, so I think it's a way of life when you think margin of safety. It's taking steps. It's recognizing there will be adverse things that happen, but you can take steps to prevent them from becoming catastrophic. That's the heart of margin of safety. You're going to have bad stuff happen. The question is, does it become catastrophic?
I thought it was interesting that you also had various processes in place as an investor that were very similar to the processes you had in place as a pilot. So you at one point, when I had asked you what the parallel was between your approach to flying and your approach to investing, you said, well, actually, I've given two of my right-hand men the ability to veto any stock pick that I make. And I thought that was so interesting, the parallel between that and your policy with Jim Dobesh of each having the ability to veto without question what the other person has decided. Can you talk about that? That seems like such an interesting and difficult thing for a 70-something-year-old alpha male to give his younger colleagues who are less experienced the ability to veto his decisions. What were you thinking?
I'm actually 76, and we've expanded that to 4 now. So it's me plus 3 others that have veto power. So I even tighten the noose more. Okay. So what I was thinking was that when you think about margin of safety and you go out to people and you say, okay, you've been here long enough. You understand what we're trying to do. I'm going to trust that you will honor the margin of safety. And by trusting you, we're just going to expand out the number of people that can veto this. So just think of what we've done. We have total buy-in for every decision. Each of us is responsible for the portfolio now, because if stock goes in, they could have voted not to ever go in. Okay. And so I think it's a really powerful risk management tool. Really, really powerful. And I hadn't thought about that, and you're helping me with this, but you're right. It's the same parallel that Jim and I had. And I took it when Jim and I did it, and I applied it to our group, and I think it works. It's a really interesting way of doing it. But what you're doing is you are honoring the margin of safety, because you're saying, look, yeah, I'm good at this, but I have my bad times. And if you guys can stop me, if you have an issue, let's discuss it.
It sounds like an odd parallel, but when I got engaged, I think I was only about 23 or 24. And I thank God I've been married to a lovely person, Lauren, for 30 years. But I was pretty, I was like, what am I doing? Do I have good judgment on this? And it was too important to take reckless risks. So I remember independently calling my father, my mother, and my brother and saying, am I missing something here? And they were all like, no, she's absolutely lovely. Good choice. Well done. And I don't know, it's a really interesting thing to do, to know even at that age that there are certain things that are so important that you actually want to not trust your own judgment. And I think I probably would have done it regardless. But to know that they all thought, no, she's great. It was immensely helpful, actually.
I think that was absolutely brilliant margin of safety application, because, and I know you well enough. I don't know you super well, but I know you well enough that you were reading their answers. When you say they all thought she was lovely, you glossed over the fact that you know how your dad was going to respond. You knew how you knew your mom's range of responses, and you gauged those. And I think you were really smart to ask them, because, my wife and I, we've been married 12 years now. We're both married before, and we do a divorce care ministry, and we tell people, look, fall in love with them, but then put the cunning business person side on and understand that how they were before you got married is how they're going to be after you get married. So just understand that, because one of the biggest problems in marriage is people think that they love me so much they're going to change. They may still love you a lot, but they're not going to change. And as a funny postscript, my wife, who's wonderful, I took her down, went to a wedding, and four of my brothers were there. And when the weekend was done, my oldest brother called me over and he said, it's been decided. I said, what's that? He said, don't let her go. That's what my brother said. And So that was a pretty good testimony. It's funny, the older I get, the more I solicit other opinions, the more respectful I am of other opinions. It's an honest dynamic. The more I know, the more I realize that other opinions, are often, I told you at the outset of this call that I'd learn a fair amount from this call. I'm interested. I picked up 2 or 3 or 4 things already from talking to you because you have some unique qualities and I can learn from that. And I'm interested in your opinion on stuff. You just keep absorbing. I mean,
I do one other thing, Fred, that really struck me when we were talking last time about flying and the way that it relates to other areas of life is you were talking about how you need to prepare before you take off because you're coming down either way, whether you want to or not, in the way that you want to or not. And I remember asking you how that applied in other areas of your life. You said when you were hiring, I think it was Nick Hansen, another of the key figures in your firm, you did, I think, 22 interviews before you hired him. Can you talk about this notion? Because you said to me also when you're buying a stock, you said before you buy, seal the exit. Don't think about the target price because you want to act as if you're really going to own it for 20 years. And again, this seems to relate to what Alex Honnold was doing with his free solo climbing.
Yeah, he was all in. But he was all in. Well, it has to do with the standards. So if you say to yourself, when we hire somebody, we like, regardless of their age, we like this to be the last place they work, then you're going to put a lot of upfront work into it because the reward could be a 50-year employee, right? And so it becomes worth it. And we've actually refined that a lot. As a funny story, it was 21 or 22 interviews with Nick. We decided to add an analyst about 3 years ago. So we had 70 qualified resumes for one spot. And so we worked it down. They did 2 essay questions. I forget what they were, but they were grueling. And multiple interviews worked it down to 7. And we have a very active intern program. So of the 7, 5 had been interns with us. So they already knew us. And then it was really nasty. We had them analyze a stock we'd owned for 15 years and said, what should we do with it? Okay. And it was a difficult company to understand. And then we because we had interviewed all of them, but we blinded the essay. So we didn't know who wrote them. Okay. So we came out with 2 kids that were head and shoulders better than everybody else. The 2, okay, had been 2 interns. There's even funnier stories on that, but we thought about it. And one of the people in the firm goes, these guys are really talented. They're not super expensive. We hired both of them. So we actually made a mid-course shift and added 2 of them. And they're both remarkable young people. One is an immigrant from Moldova, and he's preternaturally gifted at stocks. And the other is a kid who grew up in a trailer park just east of Fargo. His father's Indian, his mother's German. They both live in trailer parks. And, he put himself through college. Both of them did. And they're just these doers, and they're high integrity. And so the idea of, and it's true in a stock, the idea of, it's so tempting. And, the beauty of the markets is that you can exit a position anytime you want it at very low cost. That's the good news. The bad news is you can exit a thing anytime you want, so you don't have to be committed at all. When you got married, you didn't get married and say, well, we'll see. I'll try this for a little while. Our pastor at church says, when you get married, throw away the key. Say divorce is not an option. We're just not going there. So, boy, that really changes the equation. And when you think about a stock, why not at least in your head say, we're not buying this with the idea of selling it. We're buying it and we'll do all the work because it's so tempting. So the stock runs way up and all of a sudden, but it's not overpriced, but it's up a lot. You think, you never go broke taking a profit. So I think the idea of conceptually sealing the exit, I think, is really powerful.
I remember you saying to me once that you were taking someone out on the 20th anniversary of him being at the company. And you talked about how the first time you had met him, I think you said, if I gave you only 5 bullets this year, to buy and sell something, what would you use them for? And I thought that was such an interesting question. It's very, very related to Buffett's idea of the 20 punch cards, where you can only make 20 decisions in your entire investment career.
I think you just think about Buffett, the concept of analytical bandwidth. It's not infinite. This is one of the conceits of being a human. You think you have infinite. I'm still struck by your self-awareness to say, I don't want to read balance sheets. It doesn't mean much to me. What you're saying is I have some really great strengths. I'm going to work on those, but I don't have unlimited bandwidth. I don't have unlimited strengths, and I'm not going to try to be all things to all people. And what I said to that young guy was, I want you to conserve your decisions. We have that right now. Just think about how you manage how you run an investment team. So we spent 3 hard years. We have a beautiful looking portfolio. We generate a lot of capital gains in 20 and 21. We did some tax selling this year, so we don't have gains this year. I don't think there's much we need to do for the next 7 years. That's what a good looking portfolio we have. What do our young analysts do? People thrive on new ideas and stuff like that. So one of the things that we're going to them and saying, look, we may not be adding a lot of new names. We'll see. But what you can do is deepen our understanding of our existing holdings. And it's amazing to watch and pick up. We have a missile going on right now. It's a company that is just lit off like a candle, okay? And we're now trying to put flesh around that. How sustainable is it? How big is their addressable market? And one of the new young guys is digging on that, and it's just wonderful to watch. So, Buffett's right. You don't have an unlimited number of it. I don't know how a firm that most money managers have 50 to 100% turnover a year, which means they're always looking for new ideas, and that would be exhausting. I don't know how could you? I just can't quite understand how you could do that, because nobody has that kind of analytical bandwidth, And
this is why one of the things I wrote about in my book that it kind of, again, like most great truths, it sounds kind of mundane, but I just realized you want to be subtracting stuff, not adding stuff from your life. So you're constantly thinking, what can I remove? What game should I play? What game shouldn't I play?
Yeah.
And so I see that a lot with the greatest investors. I think of someone like Bill Miller, who's just stripped back so much of his life. So he's just focusing on what he is really good at and loves.
What's he doing now? I studied him after 2008. I was fascinated with 2008.
Oh, he's had the most amazing comeback over the last decade. But I was emailing with him earlier in the week, and he's not having the best time at the moment, because obviously he had an enormous bet on Bitcoin. Where he'd been buying since it was $200 a coin, and his average price was like 500. So he'd made an absolute fortune, and then he was the biggest individual shareholder of Amazon, whose name wasn't Bezos. So he had this unbelievable climb back. I'll send you an earlier episode of the podcast where I interviewed him.
Oh, I'd love to. He was one of my. I mean this in a very respectful way. The 07, 08 was fascinating to me. I mean, they're always fascinating, but if you predate that, I think it was 04, 05, I wrote this piece, and I said, I don't understand this. I call it the golden age of treasury bills, but part of the piece said, if interest rates are in half, how could the lenders keep reporting the same returns on invested capital? And something's wrong here. Now, I didn't do a lot of digging. I'm not a short seller. But it just struck me. And, he loaded up with dividend paying brand name financial service companies in 07 and 06 and 08, they got killed. And I thought to myself, I don't know if there was a way to figure out what they were worth. I mean, conceptually, it looked like the right thing to do. Brand names, pays a dividend, worried about the markets. But I'm not sure that, he really knew what he owned. And it was, really hard on him. But I always thought that he was very similar to us, that he had a growth mentality and he was very value conscious. And I believe that's true. I think that's,
Yeah, and a brilliant mind. Is he?
Yeah, I'll bet.
Oh yeah, he's got one of the most thrilling minds of any.
So is he? Does he still run money professionally, or is it just his own money?
but he's coming up to retirement. He's handing over the reins shortly.
Oh, he is. Did he start his own firm? Is he still a leg?
Yeah. No, he started his own firm, and so and it's had an incredible decade. I mean, I think his funds were top 1%.
Oh, really? Oh,
Yeah. So
wow.
no, he had an incredible rebound. He's he's irrepressible, Bill. He's got his.
Did you ever did you ever talk to Peter Lynch? Did you ever get a chance
I
to?
interviewed him. Sorry, I interviewed him more than 20 years ago.
Okay.
And I haven't managed to interview him since. I should again. But one thing that fascinated me about Lynch all those years ago is that I had asked him about books that had influenced him, and he was like, "Nah, you shouldn't read books." He's like, basically, it's much more helpful to play games like poker and bridge that teach you about probabilities. And
Yeah,
so at the
sure.
time, I thought, God, he's so unintellectual and uninteresting. And then I looked back at my notes a few years ago, and I was like, "Oh, that's really interesting." It was a really interesting
I
insight.
always thought he was one of the. I stood next to him one time at a conference, and he was a humble guy. I didn't talk to him at all, but I thought, and I think he was loyal to a fault. I think Fidelity gave him too much money to run. I think it just burned him out. But he was. Bill Miller was up there. Peter Lynch with there
Yeah.
are some of these guys that just are. The idea of investing in these guys that are. They're like a sports figure that can walk on there and just be so talented with some special gifts. And,
Yeah, it's a rare breed.
it is really rare.
This issue that you just raised about taking on too much money is a very interesting one. I mean, there's a very interesting thing going on with your firm, which is that you've done these things that are so not in your own interest, but are in the interests of your clients. And one of the most striking, I think, is for people who don't know the firm well, you have these two strategies. One is a small cap growth strategy. One is a mid cap growth strategy. And the small cap growth strategy, you basically closed to new investors when it hit about $400 million in assets about 15 years ago. And I remember you taking me through the numbers and saying, look, it would be really easy to have an extra $2 billion in assets, and I'd
Sure.
make an extra $18 million a year. And so I was thinking, okay, so an extra $18 million a year over the last 15 years, that's pretty nice. And can you talk about this idea of the importance of being willing to sacrifice your own interests for the sake of a client, which I'm not saying just to flatter you. I'm saying it because actually I think it's vitally important for our listeners to understand this issue of the alignment of interest between them and the person who's managing their money.
We've had a lot of questions about ESG and, what does it mean, all that stuff. And our response was a positive response, which is the gold standard in our business is a fiduciary obligation to clients. And if ESG can help, we're interested in it. In fact, governance has been a key risk factor for us. But the other stuff, we've been polite in saying it doesn't really help us. But when you unpack the fiduciary obligation, I think it's a very deep obligation. It's been around for hundreds of years. And you can't simply say we put our clients' interests first. You have to live it. And so you have to run your business carefully. You have to keep your expenses down. And you have to run your personal life in a way so that you can always be in a position to represent your clients. And so I live on a tiny fraction of my income. I do have one luxury. I own a jet, partly because I love to fly. But
even that you bought on the cheap. I remember you bought it.
Well, I did.
Something like $5.25 million instead of 15 or something.
Yeah, I did. I waited 6 years to buy it. Yeah, it was dropping $1 million a year. So it's a great airplane, by the way. But I think, what I mentioned to you in the email I sent is that all we've ever done is mid cap and small cap. And so you sort of begin to understand what size you can, what's the right size where you can still perform. I got this from my dad, by the way. He was not a great investor, but he was a customer's man, and they loved him. And he used to tell me, he worked for the brokerage industry. He used to tell me he had the most secure job in America because his customers were loyal. And I never forgot that. And it's the customers that pay us. And so, and here's the trade-off. We'd probably once a month get a thank you note. I get teased by a little bit. They're often really old, 40-year customers, women that are 95, write me and Freddie and say, Freddie, for, here's what, because of what you've done for us, here's what I'm able to do for my life, or for my grandkids and all that stuff. That's priceless stuff. I don't know what dollar amount you can put on that, but for me, that's priceless. And so, we have 40-year customers, and, I'd like to think that new people coming in get another at least 20 good years of run out of here. So you got to think about people coming in, do they have the same chance for a great return as the, people who've been here a long time? And I just think that's a really, and look, I have a great life. I do pretty much what I want to do. And I work with great people here, and we have great clients. Boy, that's not a bad place to be. And it's, but to get that, you got to give up something. And my plane would fit in the baggage compartment of some of the mega jets owned by the hedge fund guys. But you know what? I got something they don't have. So just think, I'm intensely competitive, but I just think this was a higher reason. I just think the art form is, can we deliver really great results in the context of, for people where we run all their money and shepherd them through the tough times? And can we, there's an art form to that. And so I've had a pretty good life. If I had more money, I wouldn't, and less client appreciation, I don't think my life would be as good.
I remember you once saying to me that you were interested in, I think you had set up an investment conference pre-COVID, right, where this is back in about 2017, I think, where you were talking to me about how you wanted to empower individual investors to ask the right questions. And because I think you had seen so many of your clients and other people's clients sort of fall off the straight and narrow. I remember you telling me you had one client or prospective client who went off and got ripped off by Madoff, for example.
Yeah.
The people who got immolated in the Allschlager funds. I mean, there were all sorts of disasters along the way. And I was wondering if you could give a piece of advice to our listeners who are thinking about hiring a money manager or investing in a fund. If you wanted to ask the right question to get a sense of whether that person has integrity and whether their interests are aligned with yours as a client, how do you do it? What should you be asking?
We started off, but by the way, I just finished putting it into a wonderful course, which I'll send you a link to. So I mechanized it. I paid a lot of money. It's a fabulous course. I think it's online and instructor-led. On what I migrated to is, originally I thought that their trust in our industry is really low. So if we worked on a relationship between client and advisor, that would work. But the feedback I got from advisors is, your questions are going to cause our fees to go down, so I'm not interested. Okay. Wow. So I switched gears, and I'm going to foment a revolution. My goal is 20 million Americans become empowered to ask the right questions. And I took 99% of what I know and simplified it into a few things like killer mistakes and how to avoid them. What are three things you have to know? You have to know what compound interest is. You have to know what an investment asset is. And you have to know about margin of safety. Okay. So it's, we're rolling that out. And so I switched course. So there are three things that, if you want to start a discussion with, if you're going to go hire somebody, okay, here's the three things that you start with. Not even references like, or how have you done? If you want to winnow it down, you ask them three questions. Will you figure out for me every year how I did last year? I want to know what my profits were last year. I want to know what I started with, how much I put in or took out, and what I ended up with. I want to know my net profits, and then I'll figure out what percent that is. Can you do that for me? Okay. Sure. 2, can you tell me how much it costs me in total to do business with you? And I don't mean just your fees. I want a total look at what it's costing me. Can you do that for me? And I want an annual report, and I want the dollar amount, and I want the percentage of my assets.
So that's including the middlemen who are putting you into the fund.
Everybody.
Your financial advisor who might be costing you a couple of percentage points a year.
Yeah. But then there's other fees and all that.
12B1 fees for marketing.
Whatever.
I just want all this stuff.
You're the pro. I want you to tell me what it's costing me. Okay. The third thing is, can you tell me each year, report to me what my mix of assets is, and the most important determinant of your annual volatility or your risk profile, quite the same, but we'll leave it at that, and your return expectations, your mix of assets between stocks and bonds. So can you give me those three things? Will you give that to me every year? And if you started with that discussion, okay, you're going to winnow out all but a few of them. But those are the three key questions you should always know. How am I doing? What's it costing me? And how am I invested? The fourth thing might be, the catch-all question, and that is, some really experienced guy told me, price is what you pay and value is what you get. Can you tell me, do you agree with that? And can you tell me how you honor that in what you're going to be telling me? And just listen. But the first three we'll get rid of. I'll bet you won't get, you'll get, why do you want that? Nobody ever asked that, that sort of stuff. But now you've put the questions on your ground, not on their ground. And that, because they want to talk to you about annuities or variable annuities or this product or that product or this product or that product, this special thing, that special thing. And that's all nice, but you want to know those three things. So that's what I would tell people. Those three questions.
Thanks. That's very helpful.
How am I doing? What's it costing me?
That's good. How are you doing? How much is it costing you? And
how am I invested? I just want to know what my mix is. I just want to know what I have in stocks, what I have in bonds. That's it.
So, Fred, a few years ago, you said to me, when you get older, you realize it's all about two things. It's all just about relationships and purpose. And clearly, there's a deep sense of purpose for you in managing money for people. I mean, it's not brain surgery, but on the other hand, helping people to have their, to build wealth so that they have opportunities to, retire, give money to charity, do more interesting things, pay for their kids' college. That seems pretty admirable and important to me. Can you talk about this revelation as you get older of the all importance of purpose and relationships?
Yeah, how old are you now, William?
I'm 54.
54.
So I'm waiting for the wisdom to kick in any day now.
Well, no, but you're kind of in that transition period. So, when you're young, as a guy, you're trying to prove yourself, and you're probably harder nosed than you want to be, and you're driving hard, and and you're not super relational because it takes a lot of time and effort. And you get older and you begin, you have kids and grandkids, and you get these deep relationships with clients and friends and associates, and it's just so rewarding. And they care about you, and that means you like to get up in the morning and go see them and interact with them. So that's a big deal, okay? The other one is purpose. And I have this gift. It's innate. I know how to manage money, and I love to be able to keep doing that because I can. And I've created, I don't do as much here as I used to because we've got great people around me, but I still get to invest, deal with customers, and go out and get some new business. I mean, that's the thrill for me. That's the juice. And so I don't have any trouble getting up in the morning, coming to work. I mean, it's a hoot. Most of my friends are retired. That there's not a tension there, but there's a one of my close, two 70-year friends. One's retired, the other passed away last year. Longtime clients, really tragedy. What do you do if your health is good, which is a gift, and you can really do this stuff, and you get to help other people, and you get to have a lot of fun doing it. Not a fun like giddy, but like a deep sense of satisfaction. Man, that's priceless stuff. I mean, I feel like I'm lucky. I tell people, you say, "Why aren't you retired?" I said, man, this is way too much fun. I love to do this. And everybody has their own way of doing it, but, I've seen men really, like my other friend who's retired, he's just grabbed retirement. He's just having a hoot. So he's all in on that. It's great. That's not me. I mean, I like doing this. So
I remember Sir John Templeton saying to me something about how the world is full of useless people who have retired. And he was so venomous about it. Like it really.
Well, yeah, I'm not sure. I don't know about you. I'm not quite there, but for me, is a funny story. When about 4 or 5 years, we have an annual dinner for the firm, and there was a planted question. Somebody said, "So Fred, what are you planning on to do to phase down?" And before I could answer, my wife said, "Can I say something?" And they said, "Sure." She said, "He's not coming home." So I said, "Well, you just got your answer." But I think it's a highly individualistic. My hope for you is when you're 70, you're still vigorous and you're learning and you're trying to do stuff and you have gifts and you're trying to keep passing those gifts on, and you will infect people around you. I should tell you though, that if your health stays good the problem I have now is I'm still really fit. And so, you don't like, I play tennis, but I don't play with guys quite as old. Some of the guys are 50. So, so I'm still struggling to win. It's just against younger guys now. So it's not a whole lot more satisfying, but at least you're out, doing stuff. So
when you think about risk mitigation in terms of your health and stuff, when you look back and you think what you got right that you can share with people like me who are younger and need to make better choices, what's worked in terms of what did you get right in terms of keeping your health good? Some of it obviously is just genetic and good luck, but some of it was good choices, presumably.
A very high proportion is genetic good luck, right? I mean, my oldest brother has taken phenomenal care of himself. He's the one with MS, but he's taken phenomenal care of himself. I haven't taken that, that kind of care. I've been really, really lucky. Let's not discount that. I think, but I would share this. I think, never smoked, moderate drinker, never did drugs. The other thing, I watched my dad was at 6'1", he weighed 155. He was moving all the time. And I don't know how fidgety you are, but I'm fidgety and I'm always doing stuff. So, without even trying, I have a Garmin watch. We own the stock and I have the watch and it measures my steps every day. And I average about 6 miles walking a day, just a normal activity because I'm doing stuff. And so I think if you stay active, that's one of the best things you can do. I do exercise regularly. I don't like I was on a treadmill this morning. I have to turn the TV on at 4, but I love playing sports. So, but I have to tell you, I think 80+% is genetics. I do. And 10% is luck and 10% is what you do. I think as you get older, purpose in relationships is going to lead you to better health for what it's worth.
It seems like you also had a major shift in your life when you hit your 50s, right? And you became a pretty devout Christian. And I was wondering before I let you go in a couple of minutes, like, how did that change everything? Because, I mean, that must inform your sense of purpose and your sense of being a custodian of wealth rather than it all being about maximizing the pocketbook of, you and your colleagues. Like, how did that change everything for you?
Well, so the context was I hadn't been to church since I was 17. So my marriage failed, my first marriage, and I was a central part of the failure. If you're a stand-up person at all, your marriage fails, you can't blame the other person. You're a central player. I liked some parts of where I was going, but I realized that I needed some sort of an overarching framework to go forward. And I read the 4 Gospels. I read the story of Christ, and I read it. I mean, there were some things that had happened, like I was talking to a counselor who I didn't even know he's a Christian. And he says, you have no spiritual basis to your life. And I said, you're right. So I started, and I got invited to a Bible study group by a friend of mine who quit. I went on for 12 years. But I read the 4 Gospels. And if you read that, what happens to all of us is like, I remember first time I went to this Bible study thing, I'm looking all around like, we're all these strange people, man. This is strange stuff. These are a bunch of holy rollers. But when I read the 4 Gospels, and if you actually read that and you actually take the time to read what Christ actually says in there, you can almost pick up a section and get 3 or 4 things that are just literally knock you senseless, radical concepts on how to live, how to think about things, how he answers questions, the stoning of the woman who was a prostitute, let he who is without sin cast the first stone. I mean, this is just like ridiculous stuff. And I thought to myself, because I'm a skeptic, I thought, there's no way he wasn't like the Son of God, because you can't make this up. And who in their right mind allows himself, if he had any chance to save himself and he had the power to do it, why did he let himself be humiliated and killed on the hope that we would all follow? I mean, there was no contract like saying, I'm going to do this and you're all going to do that. It was just like, anyway. And of course, all of us worry about our legacies, and he didn't have kids. He didn't have any money. And, talk about a legacy. I mean, this is like the legacy, the end all legacy, but that's part of it. So that, the other part, because I'm not stupid, I'm thinking to myself, if I do this Christian stuff, am I going to lose my competitive edge? I mean, you're successful a certain way. And what happened is actually made me a little better as an investor because I got less afraid of losing money than the next guy. I got it in the right perspective. Okay. I did something else. We talked about this idea of, running the right amount of money. How about changing your paradigm with respect to assets? So how about saying that it's not how much assets you collect over your lifetime. It's what kind of steward of those assets you are. Now I've changed the paradigm. So it's not about how much you collect. And I've become a much better steward. I've given a lot of money away, but only to places that really help, a wide variety of places that, help all kinds of people that need help, but they're effective. Okay. And it transformed my relationships. It made me I was always a natural leader and a terrible follower. And now, because I became a follower, I'm a better leader. I know that sounds goofy, but how do you lead if you're not a bad follower? Somebody said to me, well, you're so successful. How do you control arrogancy? And I said, well, as soon as I feel a little bit full of myself, I compare myself to Christ and I'm right back in the dump. Okay. So I don't have any problem. I mean, so it transformed, but my relationships got better, but I became a better investor, which I didn't know. It was one of those things. I would also tell you that I didn't like no light bulbs. I didn't like wake up one morning like, the sun is shining. I had a lot to unlearn. This was I'm still at it, but it's a long journey.
Why
So
did it
I'm
make you less
25
fearful, Fred, of losing money? Why would it have that?
Because I put it in the proper perspective. I went from not how much you collect, but what kind of steward you are. It just changed. It was a paradigm shift. So, in my charitable giving, I tell them when I give and hope for a bull market could give you more. So I don't give in bear markets. I give in bull markets because I'm investing for the future and I expect them to. But yeah, maybe I just got less. I changed the paradigm. We've talked a lot about this today about, sort of issue framing, and, like margin of safety and process. And so it reframed my view of the world. I didn't even share this with you, but, it's been a rough 3 years. We got sued by a former employee. That was tough. My middle son was killed in a bike accident last summer. He's the most wonderful young man with 2 kids.
Sorry.
Expert bike racer. And then 6 weeks after that, one of my long-running beloved business associates was hit by a train and killed.
Oh.
So this all happened last summer and in 21. And so one of the things that helped me with my middle son was the most like me. So it makes it even, he's just a wonderful young man. He's an architect, just fabulous. And I thought long and hard about it. And so one of the things that I concluded was we go through life and we have roles like, your husband. Do you have kids? I assume you do. You have kids?
I have 2, a son and a daughter. Yeah. Thank God.
Okay. So you're a father, a brother, son, okay, husband. Those are all roles you play. An author, those are roles you play. But what is your identity? And so I have multiple roles. And my identity is I'm a child of God. And that is what drives me. So that's how I can cope with losses and not dissolve in and by the way, my wife was diagnosed with Alzheimer's in March. Okay.
Oh, sorry.
So we're dealing with that. But I tell you that not to elicit sympathy. I tell you that having my faith and having my identity be as a child of God helps me weather these things it's just, the loss is incomprehensible. To this, each morning I'm reading a Bible that has little stories of mourning and, I'm still processing my son's death. It's been over a year and I'm still trying to process it. It's a real hard one to come to grips with.
Yeah, that's unthinkable. I'm so sorry.
Yeah, but
if there's something that you could share with other people who are listening, who are wrestling with their own grief or pain or suffering, what's helped you massively to deal with these sorts of things? Like when you were saying that it's helped you to think of yourself as a child of God, what can we borrow from you that's been helpful?
I think the thing that I would say is this. The other thing I really concentrate on is if something good happens, enjoy it. When a depressed person goes, well, today things are going pretty well, but tomorrow's going to stink. A healthy person goes, hey, this was a great moment. With my wife with Alzheimer's, she's a wonderful person. We don't have as many wonderful moments as we used to have, but we do have some wonderful moments. So I take those and I try to say, this is a wonderful moment. I'm going to remember that when, she can't remember something, or, her temper gets out of control or something. So I would say you can practice that. You can, again, I'm a child of God, so that's my prime identity. But if something good happens, I'm going to accept it. I'm going to say, this was good. This was a good moment. There'll be bad moments coming. I get that, but this was a good moment. What you do is you recharge your batteries. There's always a risk of being a, Pollyanna, but we've had throughout this process extraordinary acts of kindness. The way we've worked with our associate's widow has been, the whole firm rallied around her. He was a big soccer fan for the local MLS franchise, and we had rented a big box. We had a day in celebration of him. And I mean, so I think there has been a lot of miraculous things. I mean, there are miracles all the time. You just have to see them. They're right in front of you. I have so enjoyed the process of your book, at least as it relates to me. It's been a joy. I mean, I was I'd written back to you and said, our paths will cross again. I just knew they would, and they have. Okay.
Yeah.
And, I think that when people, by the way, last year, my 70-year friend died. He was a fabulous guy. He had almost a version of a brain disease that closed his throat. And after a while, he couldn't eat, couldn't swallow. And finally, was so weak, they took him off food and he died. I mean, stuff happens. As you get older, William, stuff happens, and, I think you have to understand stuff happens.
But the ability to relish, it sounds like, savor, appreciate, that's kind of been huge for you, it sounds like, to relish the good things.
This interview is a great thing. I mean, it's a chance to have my voice heard, chance to connect with you. This is a labor of love. This is not I had the example of my dad. My mom died at 67. My dad lived till he was 91. He soldiered on. It was just a crushing loss for him. He was crazy about her, and she died at 67, and he just soldiered on. So, but I think you got to just, if it's a good thing that happens, treasure it, because there'll be bad stuff, but soldier on. And I want to say this carefully, but I don't think we have the right to roll our tent up because bad stuff happens. Just don't. I mean, nowhere does it say you can choose to do that, but I don't think you need to. I've been so lucky health wise, and quick story. This is a miracle. My wonderful son's widow, was really considering suing a wrongful death suit against the kid that got tangled with my son. They were riding bikes, and I was really against it. And she decided on her own not to do it. And that was a miracle. That's the way I look at it, So, stuff happens, sometimes good, sometimes bad. And you have a choice. You're going to roll your tent up and, or you're going to soldier on, and you soldier on.
I think in the epilogue of my book, at one point, I wrote something where I said, there's great honor in the simple virtue of perseverance. Yep. And I didn't say it in a kind of facile way. I really meant it. Like the power to persevere when life sucks, when everything is going against you. There's something incredibly noble and inspiring about that simple, dogged refusal to roll up your tent.
I totally agree. And that may have been a thread that I'm even more interested now rereading the book, because I think I'll get more out of it next time. This is a fun journey, William.
Well, thanks. I was looking back at my notes from our conversations over the last couple of days, from our conversations back in 2017. And you said to me at the end that these will be the first of many conversations. And I, I think both of us feel that it's a real pleasure learning from you and chatting with you. And I'm really grateful that you come on and share these ideas. They're very, very helpful and enlightening. And so
Well,
I
I
hope you
hope
keep
so.
talking.
I hope so. I was mostly nervous that I would not be helpful enough because that's I love teaching and you're a good interviewer. So, well, good.
Well, thank you so much, and I'm finally going to let you go. But
Okay.
it's been a real delight. Thank you,
My too, William.
and
Thank you.
I'm sorry it's been a tough year, and I'm hoping that the coming one will be much brighter and happier for you.
It'll be what it is, and I will persevere. I think that's the right term. So, thank you.
Great, thank you.
Thanks.
Maybe all the shares of Berkshire Hathaway that Warren Buffett owns were accumulated using Tweedy Brown as the broker. Ben Graham in Security Analysis had a sentence that an investment operation is one that offers safety of principle and the prospect of a satisfactory return. He didn't say, and you want to be able to stay in the game. It's because it's a long run game. It's a game of averages.